The euro-US dollar exchange rate is under heavy pressure. The European Central Bank continues cutting rates, while the Fed remains hawkish. On top of this, rising trade tensions between the United States and the European Union could push the euro even lower. Where's the currency market heading in the coming weeks? Let's find out. Hi, I'm David, a financial analyst with over 30 years of experience, specializing in currencies and commodities. The European Central Bank continues to cut rates. In January 2025, the European Central Bank lowered interest rates by 25 basis points, bringing the deposit rate down to 2.75%. This marks the fourth consecutive cut, a clear signal that the European Central Bank is attempting to boost a still fragile economy. However, the broader economic picture may be more complex than it seems. On the one hand, industrial production is recovering, with annual growth of 2%, an improvement on recent years. On the other hand, overall Eurozone growth remains sluggish, particularly due to slowdowns in Germany and France. The labor market is showing positive signs, with unemployment falling to 5.7%, but inflationary pressures persist, as producer prices have risen by 1.6% month-on-month. Given this uncertain outlook, the European Central Bank has opted to maintain its accommodative stance. Yet markets are waiting for clearer signs on whether these measures will be effective. Inflation is still at 2.4%, a relatively stable level, but not low enough to justify a shift in monetary policy. For this reason, further rate cuts in the coming months are highly likely. The European Central Bank may continue easing policy to stimulate domestic demand and boost investment, hoping to prevent the Eurozone from entering a prolonged period of weak growth. However, monetary policy alone may not be enough. Without structural reforms and stronger fiscal policies, there is a risk that rate cuts will have only a limited impact and that Europe's economic recovery will remain fragile. The Fed remains hawkish, high rates for longer. While the European Central Bank is cutting rates, the Federal Reserve is sticking to a more cautious and restrictive approach. In December 2024, the Fed kept interest rates unchanged at 4.25%, 4.50%, signaling that it plans to cut rates only twice in 2025, fewer than the 4 reductions initially expected. This decision reflects persistent concerns about inflation, which, despite easing from its 2023 peaks, remains at 3%, still too high to justify aggressive monetary easing. The Fed is reluctant to lower rates too quickly, as it does not want to undo progress made in bringing inflation under control. From a macroeconomic standpoint, the United States economy is sending mixed signals. On the one hand, industrial production rose by 0.5% in January 2025, exceeding expectations and confirming resilience in key sectors. However, manufacturing output showed slight weakness, contracting by 0.1%, particularly in the automotive industry. The labor market, however, remains strong, with high employment levels and stable unemployment rates. This helps sustain domestic consumption, but at the same time, it reinforces the Fed's position to keep rates high, preventing the economy from overheating. Furthermore, the new composition of the FOMC, with 4 new voting members, 3 of whom are hawkish, suggests that the Fed may keep rates high for longer than expected. The United States Central Bank's strategy remains cautious, balancing inflation control and economic support without easing policy too soon. This stance directly benefits the dollar, which continues to attract investors thanks to relatively high interest rates and stronger market confidence. Trump's trade war: what to expect? Beyond monetary policy, rising trade tensions between the United States and the European Union are adding further uncertainty. The Trump administration has announced new tariffs on European car imports, set to take effect on 2nd April 2025. These measures add to existing tariffs on steel and aluminum, increasing the risk of a full-scale trade war between the two economies. The European Union has already warned it will retaliate, raising the risk of a dispute similar to the 2018 United States-China trade war. A full-blown trade conflict would have major consequences for both economies. For the Eurozone, United States tariffs threaten European exports, impacting industrial production and employment. In the United States, higher tariffs would lead to rising consumer prices and create challenges for businesses reliant on European supply chains. The United States-China trade war showed how damaging such conflicts can be, disrupting markets, slowing growth, and increasing economic uncertainty. If tensions between Washington and Brussels escalate, there is a real risk of a tit-for-tat tariff battle, which could harm investment, trade, and business confidence. Euro-US dollar. Where is the market heading? Given these factors, Euro-US dollar is set to remain under pressure in the coming weeks. The European Central Bank continues to cut rates to support a struggling economy, making the euro less attractive to investors. Meanwhile, the Federal Reserve maintains a restrictive monetary stance, propping up the dollar with higher interest rates and greater market confidence. On top of this, rising trade tensions between the United States and the European Union are weighing on sentiment. New tariffs will hit European exports hard, further weakening the Eurozone's growth outlook and adding downward pressure on the euro. The dollar may also be affected, but the euro is likely to bear the brunt, given its already fragile position. As a result, I believe that euro-US dollar will continue falling, with an initial target of 1.02. If the European Central Bank keeps cutting rates and trade tensions escalate further, the pair is likely to reach parity in the near future. Thank you for watching. I hope this analysis has been useful for your trading. Now I want to hear from you. Where do you see euro-US dollar heading in the coming weeks? Do you expect a further decline, or could it recover above 1.05? Let me know in the comments. If you enjoyed this video, leave a like and subscribe to the channel to stay updated on all the latest market trends. Also, turn on the notification bell so you don't miss any of my upcoming content. See you in the next video.